Hello, everyone. So welcome to the SheTrades Invest Capacity Building course on access to finance for women in the tech sector. As you guys know, this webinar course is in support of the Equals Global Coalition. This course is offered under the Leadership Coalition and has the aim to develop the capacity of women in the tech sector to not only meet the needs of investors, but also secure investment leads. By the end of this course, we hope you'll be equipped with the essential skills, knowledge, and tools to improve your company's access to finance, in addition to understanding investor requirements and also understanding which financial instruments are right for your company. So looking at the course overview, the course consists of 5 one-hour webinars on the following topics. There'll be a final course assignment at the end, and those who successfully attend all 5 webinars, either live or online, will have access to a one-on-one mentorship opportunity. So today's topic is on how to develop financial projections. We have a guest presenter here, but before I introduce him, I'd like to hand it over to my colleague Letitia, who can talk you guys through what SheTrades Invest is as part of the SheTrades initiative. Over to you, Letitia.
Thank you. Hi, everyone. My name is Leticia. I'm working for SheTrades Invest, which is the investment arm of the initiative. And under the initiative, what we do is connect eligible women entrepreneurs with the right impact investors and commercial banks. And at the same time, we help women entrepreneurs become investment ready. And this is done through online platforms such as webinars and e-learning courses, which we're actually going to launch an e-learning course on the 6th of April, but we will be communicating this, and this would be how to finance your business. So please do visit SheTrades.com, visit our project page, and learn more about SheTrades Invest. In addition to that, we will be opening the application soon, but again, we will communicate this to you. If you have not registered on SheTrades.com, I would encourage you to register in order to get all of these exciting opportunities. Thank you, Peppa.
Thanks so much, Letitia. So today, our topic is on how to develop financial projections. By the end of this session, we hope that you'll learn why financial projections are fundamental to understanding your business needs and attracting investors. You'll also learn how to forecast future revenues and expenses, and also how to translate your business ideas into numbers. So we're going to hear from our expert today, Adriame, who will present for 40 minutes, and then there'll be a question period at the end for roughly 10 to 15 minutes. There also is a chat box on the right corner of the screen, so we ask that you put your questions in the box and keep your audios on mute to avoid any background noise. I'll be taking all the questions at the end, and Adriame will take it over from here. So without further ado, I'd like to introduce our wonderful guest presenter for today. So Adriame is an entrepreneur and accomplished Africa-focused investment executive with a proven track record of successful investment activities in Africa for the past 15 years. He's the managing director of the Gambian Angel Investors Network. He's the co-founder and manager of Veritas Capital, which is a West Africa-focused venture capitalist firm providing financial trainings across the continent. He also, in 2016, co-founded Ibono Finance, a French company that connects investors with African companies seeking for funds. He's also received his MBA from HEC Paris, and has a wealth of experience on not only this topic, but accessing finance in general, and we're very lucky to have him here today. So with that, I would like to hand the floor over to him to kick off today's session. Thank you, Adriame. Over to you.
Thank you, Pippa. Thank you, Letitia. Great introduction. Good morning, everyone. I would like today to share with you my experience, my expertise in accessing finance for your business. We'll be talking about how small businesses can do financial projection in order to attract investors and maybe bankers, for example, to get a loan and even international organizations to get some grants, etc. So we will start with why do you do that? You do that usually because you need money. You need to raise funds for your business to grow. And here you can see we have different type of funding. We have grants, free money, even if free money doesn't exist. Usually you don't really need to build some financial models. When you get grants, those that giving you grants, they usually like your idea, they fit with what they are doing, and then yeah, you have IPOs, initial public offer, but I think it's not why we are here. We are talking about very big corporations that are going public, that will be listed in the stock market. I don't think we are yet there. And then the leasing part. The leasing is when you get funding through assets. So people give you assets. They don't give you the funds, but they finance the assets that you're going to have. Bank loans. So I think everyone knows how to go to a bank and apply for a loan. But what you should know is applying for a loan means you have to pay back the loan in a time, frequency, amount, and duration. So meaning that you have to have a kind of stable revenue stream to be able to get a loan. And then the last one, equity. Equity is a bit more flexible. People invest in your business because they believe in you first, because when you are leading a small business, when people invest, they usually invest in you, your capacity of delivering. And also they love your idea. They love your project, what you're doing. So we'll be focusing more on this equity side, even though once you build your financial model through the projections you'll be doing, you can use them for any type of funding, actually. You can go to the bank with that, etc. Talking about equity, we have roughly 4 big categories of equity funders, equity finance organization. We have the first part. When you start, usually you put your own money in there, or you have your family, your friends that will give you money. That's what we call the love money. I mean, everyone heard about it. Usually we say the 3F: family, friends, and fools. Why? Because you just started, and you are at the very early stage of your business, which is very, very risky for every investor. Statistics say that you at this stage 50% of the businesses failed in the 2 first years. And in our industry, angel investment, 50% failed, and 80% 50% failed, and 80% of the 50 remaining, they just returns exactly the amount people invested. So it's a very risky business. People, when they give you money, usually they trust you, they give it to you because they know you, they think that you can deliver it, and just sometimes just to support you. The second category is angel investors. These guys, they are a bit like the first category, but they are not your family. They believe in you. They believe in your business. But most importantly, they believe that they can bring value. They can add value in what you're doing. Why? Because they know your industry, or they know people in your industry, so they can provide expertise in addition to the money they are giving you, and also they can open doors. They have a large network of people that can help you to do it. The last 2 categories are professional investors, private equity firms, venture capitalists, and strategic investors. Venture capitalists, they focus on returns. They are financial partners. They focus on return, they invest, they bring value, money, and then focus on returns. The last ones are strategic investors. These guys, they are more interested in something you have, an asset, something is unique in your business. For example, there is an example in a country where a big player bought a small player. Why? Because they had a license that these big players didn't have. So they bought the company, almost 90% of the company, because they wanted this license. That's the only reason, not because the company was great or were doing good in terms of returns, etc. Another example that you all know, the acquisition of Facebook. When Facebook bought WhatsApp, they bought WhatsApp not because WhatsApp was doing great, generating a lot of revenues, but they bought it because WhatsApp had something unique that they wanted. After this quick wrap up of the type of funding, the type of financing, and the equity and the investors we have in the equity financing, now we'll say how do you attract them? How do you attract them? How do you do things that make people come in your business, invest in your business? So we start with projecting your let's say your numbers. Today you know what you are doing, but what people want to know when they invest in your business, they are projecting themselves in the future. What will happen in the future? Nobody knows, but you have to have some tools to help them to imagine what can happen. In 2 years, in 5 years' time, how are you doing? Are you going to generate enough revenues for them to get some returns if they invest? That's what we will be doing today. So it is very important to do financial projection when you want to attract those investors, because they project themselves, and then you have to help them to project. Nobody to project your business. Nobody knows better than you your business. So that's why it is so important for you to do it, and for yourself also. Doing it for yourself help you to have a better idea of on your business, how it is how you plan to develop it, to make it grow, and also know the drivers, the real drivers of your business. What can have impact on your business? That's why it is very important to do the projections. So what do you need to know is it's the most challenging part of the business plan. I'm sure all of you already did some business plans in your entrepreneur life. Not because I'm a financial expert, but I think, and people think it's one of the most challenging parts, because doing so, you need to do some previous work. You need to do some market research, for example. You need to assess your costs. You need to assess your revenue. You need to assess your business model. How you're gonna make the money. You need to assess how do you go to the go-to-market, for example. And once you have all these data down, you translate it into numbers. So be ready for a very challenging but necessary journey. And then, of course, you need to, out of all this work, the main objective is to know if you will have returns you yourself first, and for people that will invest in your business. And again, I was saying, when people take time to read your numbers, usually it means they are already attracted into your idea, your product. Otherwise, they won't take time to read your numbers. And obviously, this is done in Excel, not Word, not PowerPoint. It's an Excel sheet. I don't know if some of you already seen what we call a financial model, but we'll see one on the second part. The main objectives, of course, is to show investors that you can make money and how you can do it. Second, to translate again your business idea into numbers. Third, if something goes wrong, what happened? And also, are you able to manage money, cash planning? Most of the businesses failed because they cannot manage cash, not because the business is not profitable. The business can be very profitable, but they are not able to manage the day-to-day cash management. This is very, very important. So doing these projections help you to handle these issue or objectives. Usually people say, okay, I can do this, but nobody reads it. I can confirm that when you send your financial model to a professional investor, usually they have analysts that will build a new financial model. But it doesn't mean that you don't need to do it. Why? Because they will compare what they have with what you've sent. And then allow them to better understand also your model. But most important for them is not the bottom line. It's not that you are making a million in 2 years. What is important are the assumptions. Where do you start? What did you do the last 2 years, the last 3 years? And why do you think that in the next 2, 3, 4 years, you will do, I don't know, 50% of growth, for example? That is the most important. And also, we know that when you do projections are in the future, right? Meaning we are almost sure that it won't happen. So why are we doing it? It won't happen. The future, we don't know the future. Why are we doing it? The reason why we are doing it is not, again, the bottom line is the way, how you are going to do it, how you translate your business model. It's not the actual result, but the way you get there. That's what they want to understand. If you translate well your business into this Excel sheet where you describe how the revenues are coming, how the costs are coming, and how you plan to make all these numbers make sense, all these numbers. So very important, the right assumptions at the beginning, and how you're going to do it. That's what we're going to see. These are the main component of a financial model or financial projections. You have to have a page, assumption page, where you describe what you call assumptions. For example, is sorry, some people are saying they cannot hear me.
We can hear you well.
Okay.
Okay. Please, everyone else, please make sure that to connect to your mic, and please remember to mute your mic.
Okay. So when we are talking about assumptions, it means, for example, when you start your business, you will start with, I don't know, 2 people, 2 salaries. This is assumption. Why 2 people? When you start your business, you will say, I need to have an office. Maybe you don't need it. Maybe you need it, and it will impact the cost, of course. You will need to buy, invest. When, for example, when you are running, when you want to run a restaurant, means you have to buy your raw material. You have to buy your vegetables before you start cooking your first meal, right? These are the assumptions. You start with something, and this something usually is based on market research. You start with market research, and then market research, or what you call traction, what you are doing in the last few months, few years. And then you have 4 fundamental components. The first one is the profit and loss component, profitability. It will assess the profitability of your business. Is your business profitable? The second one is the balance sheet. The balance sheet show your financing requirement, your assets. What do you have? It's a snapshot. The profitability is over a period, usually a period of 1 year. The balance sheet is a snapshot at one time of the requirement, the financing requirement of your business. The cash flow, the cash management, how you manage your cash. Again, you can be profitable and bankrupt. Why? Your business can generate money over a period of 1 year, but If today you don't have enough money, enough cash in your bank account to pay your salaries, they will leave. It doesn't mean that you won't have money, because money will come in 2 weeks, in two months, in 3 months. But now, right now, you need the cash to pay people. To need the cash, you need cash to buy raw materials, for example. If you don't have it, you close. So this is the difference between cash management and profit and loss. You can be profitable, but not having cash can make your company in danger. And then the last component is, of course, the return for the investor. They are always looking for returns. How and when they will get their returns. This is very, very important. So what we will be building, we will have these 4 components. I think we'll see them on the second part, I think later this month, where we will have the actual financial model in Excel. And then, of course, these you will present them. Usually, what we do the first year, we'll have a monthly projections, and after 1 year, now you start having yearly projections. Why? Because when you do a monthly projection, people will see if your business have seasonalities or not. If you are in the agriculture business, for example, if we say, for example, in Africa, you know that during the rainy season, you have, or even the tourism sector. Let's say everyone knows tourism sector everywhere in the world. Tourism sector is seasonal, right? So on the high season, you have a lot of money, people coming. On the low season, very few tourists coming. So if you don't do the monthly projection, we won't see seasonality of your business. Saying that during the low season, you have to have enough cash to make sure that all your infrastructure are in place for the next season coming. So very important to have this monthly projection. And of course, Excel is your friend. Excel is your friend. Everything is done in Excel. So make sure that you can use Excel. So now, how do we do it? Usually, we start with the cost. Why? Because doing the cost, projecting costs are more easier to do. Why? Because you know them. You know the cost. When you want to produce a bag, for example, a leather bag, you know that you have to buy the leather. You know that you have to buy some raw materials, and you can know the cost. You have to call any friend that is doing it, or someone you know that is working in this industry, and he can give you the cost. So you know the cost. You can know the cost, and usually you know how the cost evolve over time. You know your marketing budget, for example. You know how much you're gonna pay your employees. You know how much investment do you need at the beginning. So usually starting with costs will help you, because very easy to know. With a very short, quick assessment, you can know your cost. We start with that. Not very difficult. And then the revenues. These are more challenging. Assessing revenues, you need to do some market research usually. Why? Because if you come with your business, usually you have something specific, something that your real value proposition, something unique for your business. What is it? It can be new. So if it's new, you cannot just go and copy something that exists and then present it. No, you have to do some market research. You have to go in the market, see the market size, what is your target market, etc. You have to price. You have to price your products. Not easy. What type of product I have? If you have a commodity product, meaning if you are selling rice or eggs or whatever it is, there is no value in the product. So it's a commodity. The lower the price is, the better you sell, right? But if you are selling Gucci, for example, or Chanel, No, this is not a commodity product. It's a luxury product. So the price won't be the same. You don't fix the price because based to your cost of production, you fix the price based to something else, the value you are bringing. When you when you have a bag, a Chanel bag or whatever this luxurious brand, you enter into a room, people see you, oh yeah, she has this very nice brand. So people value you because you have this brand on you, right? So when these guys, they fix their price, they don't fix it because it costs them this to produce it, but because they know the value they are bringing to you. So revenues, it's about market, number, and price. Number of items, time, price. This is the revenue you are. So these are the two things you need to assess, and you need to do it over a period of 3 to 5 years. Not really easy to know in 5 years what will happen. In 3 years, most likely, but still difficult. In 1 year, it's easier. And again, very important to break down the first year in 12 months to see the seasonality of your business. So let's see a quick example on market assessment and revenue estimation. It was a pitch from Airbnb, I think back in 2008, for the first pitch. And I think they raised the first investment during that pitch. So they start saying the market size of all the trips booked worldwide is about 2 billion. 2 billion people. Is their market? Obviously not. And they said only 500 million book their trips online, because their business is an online business, right? But this is not enough, because on online business you have also people that book to go to hotels, to go to resorts, to go to cruise, etc., etc. What they are interested in is people booking trips for Airbnbs, going to people's house. And then they said these books today is about 10 million, 10.6 million. Very precise. So when you go see an investor and say, oh yeah, my market is 2 billion. Oh, they say, oh, great, 2 billion, but 2 billion is large. Do you really know your market? If you are not able to do this segmentation, people will think you don't know your market. If you don't know your market, you don't have a business. So very, very important to really assess your market. And now, once you have your market size, this is the whole market, 100% of the market, 10 million. Of course, they won't have the 10 million. They will start with maybe, I don't know, 10% the first year, 20%. Now they are Airbnb. Now they are leader in this industry. But back in 10 years ago, obviously not. And then they say, if we have our market now comes the pricing, right? We want to take $20 on every booking. They know that on average, the booking fee is about $70 per night. And usually, on average, people book 3 nights. So it makes $20 times 10 million is about 200 million. So this is there at that time, the maximum revenue they could get in 1 year, the maximum revenue. But luckily, they were very, very lucky, because internet helps them. Today, almost everyone books their trips online. So the market.
Adrian, we just have one question on the expenses part before you move on. Do you think you can answer a quick question?
Yeah.
Okay, great. So BG can go ahead now and ask the question just before we move on. So please unmute yourself to ask the question. And yes, everyone will get the PowerPoint and training video afterwards.
Hello? Can you hear me? Hello?
Yeah, we can hear you.
From Guinea Conakry.
Mm-hmm.
Okay, before we go ahead, please, I have one question regarding the start with cost. Okay,
Mm-hmm.
the details of relevant expense and activity. I'm doing the business for people, okay, and for some enterprise also.
I'm sorry, I cannot hear you well.
Can you hear me?
Yes, now I can hear you. Yes.
Okay, sorry. Okay, it is about this slide. My
Yes.
question is about regarding the fixing cost and the OPEX.
Yes.
Okay. Uh, the salaries of the employees will be included on the fixing cost or in the OPEX in the charge. I'm very confused about that because
Okay.
this is information if you are going to start the business.
Okay. Um, I'm not sure if I get I get it right, but I think your question is about is the wages, the salaries are going into the fixed cost.
Yes, yes,
Okay.
or OPEX. Yes,
Or OPEX. Yeah,
yes,
but OPEX and fixed cost is something different. OPEX is what we call operational cost.
yes, yes.
Okay. So we have OPEX and we have um, the investment costs, right? Operational costs, that are the costs for running your business. So to run your business, obviously the salaries are in there.
So the salary will be in the investment.
No, 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 no.
OPEX.
The investment, when you the investment are the money you put before you start your business. For example, if you want to start a restaurant, uh, you have let's say a hotel, right? Before your tourists come in your hotel, you have to build the infrastructure, build the hotel, have your swimming pool, have your beds, have your sheets, etc., etc. Everything has to be ready. This is the investment.
Okay.
But you have this investment before start running your hotel. When you run your hotel, now you have people coming in there as a client and also people working there. And these people working there get them salaries
Okay.
every month. Every month means operations. Operations means things you do, you repeat again and again. And salaries, you repeat them again and again, right? So it's on the operation and not in the investment. Is that clear? OPEX means operational cost. Yes. Okay. So now,
Okay.
now, the second part of your question is, I think,
The fixed
are
cost.
the salaries fixed cost or not?
Yeah.
Okay. Usually, fixed cost means something you cannot work, you cannot reduce, or they are here every month. Meaning, for example, your rent. When you are renting a office, every month you have to pay your rent. This is a fixed cost. You cannot change it. Salaries are something between both. Sometimes people put them on the fixed cost because you know that almost every month you have to pay three people. The salaries are almost fixed, but you can work on it. I mean, if you are in difficulties, you can reduce people, you can reduce the salaries, you can work on it. So most people don't put them on fixed cost.
Okay.
Is that clear or not?
Is that clear? Maybe for me it will be different regarding the type of the business
Yes.
and the timeline also for the projection. We are going to make the projection for 1 year or
I'm
2 years.
I'm having a hard time to hear you. You are a
I'm
bit far, I think, of you from your
okay.
microphone.
Sorry, yeah, I'm saying that maybe it's dependent of the type of business or the timeline where we are going to do the projection of your business.
Okay, I don't know
Because
if we have enough time, but in 30 seconds, just tell me what is your business. Maybe everyone can benefit from what you are talking about.
okay,
And
for
quickly,
example,
very quickly.
okay, regard for example the agro business. Okay, if I'm going to make culture maraîchère. Sorry, I'm French. I'm coming from French. Uh, for
I
example,
speak French.
yeah, okay, okay. La culture. Par exemple, je vais faire une culture maraîchère de tomates. De tomates
Okay.
pour 3 cycles. Et c'est chaque 3 mois, chaque 3 mois. Là,
Okay.
je prends des maraîchères.
Okay.
Je vais payer avec le même salaire pendant les 3 cycles, c'est-à-dire pendant une année. Par exemple, là, est-ce que je peux
I
faire...
can I sorry I cannot hear you. Can you be closer?
Ok, sorry. Ok, par exemple, si je prends l'exemple des tomates, ok, je
Mhm.
suis sur 3 cycles.
Mhm.
Et chaque 3 mois,
Mhm.
pendant les 3 cycles là, j'ai besoin des agents qui vont nettoyer. Donc, je peux donner des salaires fixes pendant 9 mois. Donc,
Mhm.
dans ce cas, est-ce que ce sera OPEX ou bien ce sera charge fixe?
Okay. Again, OPEX is something different. Okay. Charge fixed, fixed costs and variable costs are something. OPEX is operational cost. It's please make sure that you make the difference. Salaries are in the OPEX. Okay. This is nothing to do with variable or fixed cost. OPEX. When you pay a rent, it's fixed cost in the OPEX.
Thank you
Salaries,
for the clarification.
yes, salaries, uh, salaries are variable costs because you explain it. You have a seasonal business. You have 3 seasons when you do your tomatoes, right? So
Yes.
every 3 months you pay people. It means maybe there are some months you pay nobody. So it means when we see the whole year, sometimes you pay salary, sometimes you don't pay salary. Why? Because your business is seasonal. So it means it's variable. It's not fixed. Something fixed is every month you pay, or every year once. There is a fixed frequency, a fixed a period where you pay this. This is fixed, and the fixed amount also. Of course, the rent can go up, but over a period of a year, it's fixed. This is the
Can I
difference.
suggest we move all questions to the end and just go through
Yes.
the presentation because
Okay.
we are running a bit short of time. And
Okay.
some of the questions you may answer in your presentation.
Okay. Okay.
Thanks, everyone.
Okay,
So
thank you.
to continue on the revenue, so as you can see, it's very important to make sure that you assess quite well your market and then your pricing. And then you have the revenue. So once you have the revenues and the cost, you have something like this, meaning you present your numbers in a sheet into your business plan very clearly. You have your products, the revenues you are generating from your products, cost of goods sold. I saw someone asking for the COOGS. It's the cost of producing your products, and then you start adding your marketing costs, wages, office rent, etc., etc. And at the end, you have the profitability of your business. You can see at the first year we are losing money, yeah, minus 52, and then the second year we lose money. The third year we start generating money. So this is, once you do your projections, this is what you have to have. We will see it on the second part in a more practical way. And then once you have your profitability, you have now the request for the investment, meaning, okay, now I want to launch my business, or I already launched my business. I need to do some investment. I want to expand, or whatever reason you have. Once you do this, uh, you have some cash that is missing, and this is the need for your investment. Once you work on your financial model, and then on the cash management side, you will see somewhere you will have something minus a number, and this number is your need actually, and then that's where you go and raise this number in terms of funding. Again, this is just example of what we'll be seeing in the second part, where we'll actually see the real numbers and how we generate them. I know that it's not easy to read the numbers right now. These are just snapshots of something, but we'll get into that in the second part of this course. But very important to have this request for finance generated from your activity. And then the returns. The returns, I don't know if you are familiar with these ratios, the NPV, the net present value, the payback period, the IRR, internal rate of return. Usually investors look at these type of ratios, and it will give them a way, if it will give them, we are 4 minutes to the end, okay, and it will give them some elements on the profitability of their business, if they can invest or not. So quickly, the payback period, for example, is when your business starts generating positive revenues. You can see here the business starts having positive positive cash in year 4, meaning if these investors, they want to get back their money in 3 years, they want to invest, because the positive revenues start coming in year 4. The internal rate of returns is a type of, to make it simple, let's say it's a kind of interest rate for investors. Like the bank, you go, you have an interest rate. It's similar. It's not the same. It's similar. The difference is the interest rate, you have to pay them every month. Here, you don't need to pay them. You have it or you don't have it. They take the risk with you, but they will work with you to have it. We are running short of time, but we have three slides left. Now, once you have your numbers, once you have your needs, once you have everything, I started saying that the future will not happen. What we think will happen in the future won't happen. We don't know the future. So that's why it is very important to test your model, to say what will happen if something goes wrong. Reducing my revenues by 50%. Oh, when I will get back my returns? Instead of 3 years, maybe I will get them in 10 years. So I have to be very cautious on this. If I increase the salary by 10%, what will happen? If I lose my license, what will happen? These, what we call scenario analysis, help you to really find the drivers of your business. This is very, very important. It helps you to find the drivers of your business. What will have impact in your business? You change some assumptions, and then you see what happened. We will see it also. So usually when people do this, they do some mistakes. They say, oh yeah, I'm very conservative. No. Or there is no competition. The first time I heard someone told me I don't have competition, I drop it. I drop it because there is always competition. Always. You have to be able to explain your assumptions as well. You have to have this scenario analysis. Also, here we said stating projection to the USD 0.01. It means simply don't go into too much details. Right? You don't exclude taxes. It's in there. Depreciations, you have to have them. No break-even analysis, meaning when your revenues start being higher than your cost. When you start, usually your costs are higher. And then you start generating revenues. This point we need to know when is it. You don't exclude your salaries. You are an entrepreneur. Usually people start their business and they don't pay them a salary. You know what? I don't know if you know it or not. When you go to see an investor, you say, oh yeah, I'm not paying myself a salary, and you think you are doing good. You are doing bad, actually. Why? Because they say if you don't pay yourself a salary, you are taking money out of the business, and it's illegal, right? So it's very important to make sure that everything is on place. Now the last slide, the final, the tips. You have to be very clear on what drives your business, your assumptions. If you make a scenario analysis, what is more impactful in your business? You have to know them. because they will know them. Investors, they will know them. They will do their homework and they will ask you questions. Okay, you have to be optimistic, but also realistic. Too much optimism is not good. You have to know your audience. When you go, you have a business, you go see your clients. Of course, you do your due diligence. Before you talk to anyone, you have to know who you are talking with. What are the key drivers? What they are looking for? Their goals. It's the same here. Do your homework. Choose the right level of details. Your projection should be between 3 to 5 years. After 5 years, it's very difficult to do projection. Less than 3 years, we don't have enough data. So it's between usually 3 and 5 years. Also, you need to have your cash plan. Very, very important. Very, very important. And then, lastly, I know that you are entrepreneurs. You need to talk with specialists. Sometimes they won't charge you anything. Why? Because they might be your accountant, for example. They are familiar with numbers. They can help you. You need to get the right help. Very, very important. I think that's it. We can go for the questions. And thank you.
Thank you so much, Adram, for that. I think I can speak on behalf of everyone and say that was very insightful. So we can take questions from the floor. I'd ask that everyone write in the chat box your questions, and then Adram, you can address them point by point.
Yeah.
If you could also go back to the slide that has your contact details. I know some of the women entrepreneurs are interested in reaching out to you. So if you just give them a moment to jot down your contact info, and then you can start answering questions.
I think my contact.
The one is right before that there.
Yeah. So you can reach me on LinkedIn. I'm very active on LinkedIn. Since this is my LinkedIn. On Twitter, less active, but I'm there. And also you can send me an email on Adjame and John at vertiscapital.net.
Perfect, thanks. And I see we have the first question. It says, please explain what NPV is with an example.
Okay, let me come back here. NPV, it's here. For example, if you take this example, it's 78.92, let's say 79, right? What it means? It means here you have the free cash flow, the free cash flow line. So you invested 200, and every year you generated some money that you can, some money. Okay, I'll give you again my emails at the end, no problem. So money that you will generate every year. So in year 1, you generate 46. In year 2, you generate 56. In year 3, you generate 60, etc., etc., etc. And then what we do, we discount this free cash flow. Meaning, free cash flow means the money that is generated. You can use it as you wish. It's your profit, right? You paid already everything, and then we discount these revenues in today. So today, 46 was 44, 50, or 56, etc., etc. And then today you invested 200. Year 1, you will get 44, 46, but was 44 today. I don't know if you are familiar with this discount cash flow or discounted element. Very important to know how to discount something. And then, actually, when you start adding up 200 plus all this revenue generated, discounted to today, you have 78. This is the NPV, the net present value. Net present value means if you take 5 years ahead, all the value you are going to generate, you discount them today, how much you get. This is the NPV. It's roughly the money you're going to generate in the next 5 years, to be simple. I don't know if I answered to the question.
I think that was clear, Adrian. We have a few more questions. One of them, can you explain what the payroll expenses are and also explain the difference between a target market and market segment, with the example being if someone produces garments for women, men, or children, what the difference between the target market and market segment is.
Let's say when you segmenting your market means when you have a product, you say this product, I want to sell it to some people. For example, if you do the example you were giving to me, people, it was the garment for something, I don't remember.
Yes, in the garment sector.
Yeah, in the garment sector. You want to sell your bags, etc. to women. Of course, your first target are not men. So when you segment your target, you say, okay, my target audience are women between this age and this age, for example. But you know that in that segment, some have enough money to pay, some they don't. Some they might like this type of bag, they might not like, etc., etc. So you assess them and you segment them and you say, this group, I know that they can afford my bags. So this is the channel I'm going to use to sell them my products. Maybe online, they pay cash. This group, maybe they want it, but they are not able to pay cash. So maybe we'll set up something with a bank or whatever it is, financial institution, for example, to allow them to pay gradually, to pay, for example, if they have to pay 100, they pay 2 times or 3 times, for example. So you have two groups of clients with different attributes, and then you address them differently. This is the segmentation. You segment them, meaning you know every group, what are their needs and how you're going to address them, right? The target customers, target clients are the whole group, people that you are targeting to sell your product. This is the target. The segmentation is in that target. Now you segment them, you divide them into different groups to address specific needs.
Great, thank you. And another question that was asked through the board, one, what payroll expenses are, and two, how to calculate depreciation.
Okay, how to calculate depreciation? I will come into that. So how do we calculate the payroll? That was the question?
The question was, what are payroll expenses? So if you could give a few examples of what payroll expenses are.
Yeah, payroll are everything related to salaries, wages. Payroll are just that. You know, when you pay your salaries, when you pay your employees, you have to pay them the salaries, okay? You have the gross salaries, for example, and then you pay taxes on these gross salaries, but also you as an employer, you pay taxes to the government because you employ them, etc., etc. So everything related to paying your employees are payroll, to be simple. Everything related to the salaries, taxes, everything is included in there. Okay.
Great, thank you. And is how to calculate depreciation.
How to calculate depreciation. Depreciation, let's say when you buy a car, you buy the car for, okay, let's take a computer. We all have computers. When you buy your computer, over time, your computer is losing value because it is getting old. So it is being depreciated. Your computer is being depreciated over time. So usually depending on the country, but usually in Europe, for example, we say a computer is depreciated in 2 years. For example, if you buy your computer today, in 2 years, your computer will lose value. So it means if you buy it for 100 today, the first year you will lose 50 in terms of value. The second year you lose 50. That's how we calculate depreciation. And you take a car, for example, it's usually 5 years, right? You divide the price by 5. At the end of the 5 years, your car has no value. Okay. When you take a building usually it's 20 years, for example. So do some research, and you will see, depending on what you want to depreciate, there are some generic assumptions on those things. But it doesn't mean that in all countries, in all businesses, you depreciate your car in 5 years. You can depreciate in 10 years. okay? But you know that some elements can be appreciated, not depreciated. For example, if you take the luxurious brands, usually over time they get appreciated. If you take a watch, for example, some watches are getting appreciated over time. If you take these very expensive cars that was built in the 60s, for example, now they worth millions. Yeah, so there are few things that get appreciated, but generally speaking, assets you have in your business, they got depreciated over time. I don't know if it was clear. So usually you just take the price you bought them and you divide by the years of the depreciation, 5 years, 2 years, 20 years, and then you have the number.
Yes, that sounds clear to me. Thank you. Another question from the floor is, could you please explain what EBIT is in the context of return for investment? And what is a necessary ratio?
EBIT. EBIT. That's the question. Hello?
Yes, that was the question from the Association of Women.
Yes, EBIT or EBITDA. We have EBIT or we have EBITDA. EBIT means earnings before interest and taxes. Interest because if you get a loan from a bank, you pay interest, and it is in your balance sheet. Sorry, not your balance sheet, your income statement. Here we have an income statement. So earning money you have before you start paying tax and before you pay your interest. And EBITDA with A at the end is earnings before interest, taxes, and appreciation or depreciation. Okay. And the next one was? The next question?
There's another question on what is IRR and how is it calculated?
Okay, that's what I was saying. Today, to be honest, I cannot explain you how it is calculated, but if you go on your Excel sheet, you write IRR, you will see it, okay? It's very simple. It's a kind of interest rate. Again, an interest rate, how do you calculate an interest rate? Interest rate, and you go to see a bank, because for me, I think it's the best way to explain it. It's completely different, but it's the same idea. When you go to the bank and you want to get 100 to the bank, and bank say, okay, I will give you the 100 and you will pay 5% interest rate. You know what 5% means? 5% is the cost of them giving you the money. They have costs on this. They pay people, there is a risk for you to not reimburse, etc., etc. So they said all these things was 5%. So every month, every year, you pay 5% out of the 100 you're going to pay over the period, the period of the loan, 2 years, 3 years, 5 years. This is almost the same. The only difference is when I am an investor, I invest in your business. I will say I expect to have 70% of return in my investment. Every year I have to have 70% of return. So it means if I invest 100 over 5 years period, I expect, not I have, I expect to have 16 or 17 every year. 17 every year, meaning 17 times 5, plus the money I put in the business. So it's like an interest rate, but guess what? If the money is not generating money, if the business is not generating any revenue, any profit, there is nothing to pay. But if you get a loan from a bank, you will pay the loan. Doesn't matter if you generate revenue or not. This is the difference. Because when I invest, I know that the first years of my investment, I won't have this. Maybe we are going to lose money. Maybe at the fourth or third year or fifth years, I start having 30% in terms of returns. And then on average, I have my 70% over the 5 years period. But if me, investor, I have 70% of return, it means you also you have 70% of return because we are business partners. The business, the revenues I'm generating are generating out of the business. So you are partner, you are generating the same revenue. I don't know if it's easy to understand, but I think the easiest way to understand it is that way. Now, to calculate it, it's very, very challenging. For some of you that are interested, I can send you anything on that. But just have in mind that it's kind of something like an interest rate. But you are not obliged to pay if you don't generate money. And usually you don't pay them. Actually, you don't pay. You just accumulate the money into your account till the investor get out of the business, because this is very important. It's not the matter of what we are. It's not the topic of today. But when you have an equity investor, usually they get out of business after a certain period of time. They exit. When they exit, they get the value they created over this period where they were your partner. And when they do the exit, they do the valuation of your business, and then they say your business was 1,000 today. I have 20% of your business. It means I have 20% of 1,000. So I will sell my shares of 20% of 1,000, meaning 200. He will go with 200. So now once we have his 200, now he calculates compared to what he invested, he will get a return on investment. That's how it is calculated.
Thank you. So I'm aware that it is now an hour's past, and we'll have to unfortunately close the webinar shortly. I know there's a number of outstanding questions. Luckily, the next session is also on creating financial projections, and we'll have more of a practical element. It will take place on the 25th of March at the same time. And given the multitude of questions, we can consider making it a bit longer to ensure that everyone's questions get answered. Adrian has also indicated his email here and has said that he's open to answering questions as well. And in addition, we will be sending out the course slides as well as the recording of the webinar via email and also posted to the Equals website. So I'll be following up later today with both of those things. And then I guess before we completely wrap up, I'd like to give Adrian a warm round of applause and welcome and thanks for teaching us about this important topic. I know it's much appreciated, and from what I can see on the work chat, the participants enjoyed it as well and learned some concrete things. So once again, thank you.
Thank you so much. Thank you. I think it's a great opportunity for me to talk about this topic with this audience. I'm sure most of you already know a bit of what you are doing. You know your business, you know everything. You just need to translate those things into numbers. And this is a very good opportunity for you, but also for me. I'm very happy to be here, very happy to share what I know, what I experienced over the years with you guys, and will be available on my LinkedIn, my emails. If you have any questions, I'll be happy to answer those questions. Thank you so much. Thank you.
Okay, great. And on that positive note, I'd like to thank everyone again for joining. I know we had participants from Argentina to Africa and all the continents in between. So once again, thank you, and we hope you guys tune in again on the 25th of March at the same time.
Thank
See
you.
everyone then. Have a great day.